Hello everyone. Welcome back to another episode of our Energy podcast. Today, Govind and I, Garif Bhella, will be bringing you your weekly dose of financial literacy. Our usual and beloved host, Aryan, couldn't make it today, as he's slightly under the weather, but he's recovering and he'll be back with you next week. But having said that, let's continue with our episode. In the last few weeks, we briefly touched upon how the young and new investors often tend to be very risk averse. The moment they see something red in their portfolio, they realize, or in their investments, they realize that you know that they're losing money. They are. It's just a signal for them to get out of the market, and that's what most of them actually do. Today we'll be talking about something which is very interesting and very relevant in this sense: debt. So Govind, why don't you introduce us to the concept of debt?
So thanks, Kara. So I think it's a natural progression for us to discuss debt today. Episode 1, we discussed broad portfolio construction with equity, debt, real estate, and other things. Episode 2, we discussed equity. And now it's a natural progression to debt. So why would someone invest in debt? Everyone has to keep some money for emergencies. Everyone has to keep money for short-term needs. Everyone has to keep money where they don't want to lose their capital. So debt is essentially to cater to that kind of money where you don't want to risk the capital, where you may need it in the short term, and where you want to be sure that it doesn't go away. So that's what debt is for. And debt, there are multiple types of debt. So happy to have a discussion, answer some questions, but debt is essentially fixed income on your capital with a high level of capital protection.
Thank you, Govind. But I was just wondering, as you said, that there are different types of debt, and all of these debt carry different risk levels, right? So if I want to get the maximum return, which debt instrument would you suggest that I invest my capital in? Because I need to be assured that I get some returns with while there is some risk capacity also, a low risk capacity.
Correct. So that's a good question,
Yeah.
Kara. So basically, it's a curve. At the bottom of the curve, which is lowest return, lowest risk, would be your fixed deposit with banks like HDFC, SBI, your savings account, and your government bonds. At the highest end, a few years back, there would be corporate bonds which are rated. So there's something called credit rating. Credit rating is given by independent agencies where they rate a company or a government or anyone who's raising debt on the basis of their ability to repay. And how it works is there's AAA, AA, double B, triple B. The lower your credit rating, the higher interest you'll have to offer to someone because they're taking that much more risk. So till a few years back, your corporate bonds of companies that are double B, triple B would offer 12 to 14%, where you could buy a basket of these companies and hope that there's a default in small amount or none of them. But today with fintech,
Govind,
hmm.
what exactly do you mean by defaulting, and what is a corporate bond?
Okay, so corporate bond is today, for example, say a company, let's say Reliance, wants to build a power plant or build a refinery. There are two ways they can do it. They can either raise equity where they're diluting their ownership, but there's when you raise equity, you dilute ownership, but then there's no time bound that you have to pay an interest. So there's obviously advantage and disadvantage of equity. Or you raise money by debt, where you're not diluting your ownership, you're raising money by debt, but there's a definite period you need to repay and the capital has to be paid back, right?
Right.
So a bond is when a company raises money on a particular interest rate where retail investors and institutions can participate in it. So in a way, it's like a fixed deposit, which you're, instead of giving it to a bank, you're giving it to a particular company.
Right.
And because
So,
banks are
what's the difference
largely
between a
owned,
fixed?
government bonds are owned by the governments, companies are owned by different individuals, companies always tend to give a higher rate of return so that people want to invest in their bonds instead of investing in fixed deposits or government bonds.
So you said that a corporate bond offers higher returns than a normal bank FD, right? But
In
they
most
are more
cases.
riskier than okay,
So
okay.
today, for example,
So
I'll give you a practical example. If Tata Group takes out a corporate bond and Yes Bank takes out an FD, I mean, both would be similarly treated, right? So corporate bond really depends on the balance sheet strength and the
is
reputation of the
this
corporate.
because okay, so what I see here is that there's a direct relationship between the risk you take and the returns you get, right? So
Yes,
the higher the risk, the higher the returns.
correct.
Okay, so whatever was applicable in equity is also applicable in the debt market in terms of the risk reward
Not
ratio.
necessary. In equity, there's
Okay,
portfolio theory where you can keep lowering your risk and try to maximize the return. Whereas in debt, it's as linear as it gets. I mean, debt is the only, it's for sure higher the risk, higher the return.
okay, nice. And but there are very different debt instruments, right? So there are debt mutual funds. There are, and as you said, there are also bank fixed deposits. So why is it that most people in India give their money to fixed deposits rather than investing in debt mutual funds or corporate bonds? Because as you said, they offer slightly higher returns, right?
So let me just take you through the whole chart. So bottom,
Okay.
as I shared quickly, fixed deposits, government bonds, and
If you
your
could also
savings
give a
account.
brief description about what each of these things mean, what each of
Fixed
this
deposits is
instrument is.
basically you give your money for a guaranteed period to a bank which you can break prematurely, and the bank gives you a certain amount of interest.
Okay.
Banks are mostly credible. Similarly, governments issue bonds. They may be taxed, they may be tax free, where you're literally giving money to a public sector unit that is owned by the government, which is giving it to the government directly, and savings bank account
Mm-hmm.
which is leaving it. So those I would call the lowest risk, lowest return overall. Though sometimes
Okay.
government bonds become tax free, and that time it becomes a better yield because tax free is a significant amount of tax that you save. Post
Right.
that, I would say, is where your so debt mutual funds is such a vast universe. I mean, there are overnight funds, there are PSU debt funds, there are corporate bond funds, but in
Yeah.
general, debt mutual funds aim to invest in multiple securities so that the risk of default is reduced. So suppose you invest in a banking and PSU fund, they'll invest in CDs and bonds and instruments of banks and PSUs.
What exactly is a CD?
See, CD is a certificate of deposit issued by banks to other institutions. It's a little complex, but it's a debt instrument.
Okay.
So banks raise money to lend. They raise that money in multiple ways. CD is one money. CD is one way. So mutual fund
Right.
essentially would have 40 different debt instruments and try and get a
Mm-hmm.
better return than a fixed deposit.
Okay.
So I would say bottom category we've already covered. Mutual funds would cover a large element of the curve, which in today's
Right.
maybe 7 to 12%.
Right.
And taxation again becomes a big play. And post that is where you can have individual corporate bonds that come in.
So, Govind, as I understand, we've already covered topics relating to when and why you should invest in debt. But how should one allocate their money to debt instruments in their portfolio?
I think maximizing returns from debt is a very underappreciated skill because people are like, if we want to earn higher returns, we rather do equity markets. Debt kar rahe hai to do FD and be simple about it. But I think that 3-4% earned with proper risk management over 10 years is a significant amount. So
Hmm.
one thing I've realized is, which we didn't cover till now, there's something called as a PPF. You can
Yeah.
invest up to 1.5 lakh in a PPF where you get tax-free interest. So a PPF can be, it's called a public provident fund. It's to the government only and it's tax-free. And the interest is always a percent or two higher than fixed deposits. So
Right.
for youngsters, and I have seen the power of PPF in savings because it accumulates every year after year till 1.5 lakh. If I was a young guy, I would just allocate it to PPF for sure. You get 1-2% of a fixed deposit. It's tax free or given to the government.
From what age can one start investing in PPS?
So you've caught me by surprise, to be honest. So
Okay.
I don't know the answer myself, but I have a daughter who's turned 2. So they have something called as Sukanya Samriddhi, which is a PPF for
Okay.
girls, which even gives a higher interest rate where I can invest up to 1.5 lakh rupees a year. So I'm assuming you can start from the age of 1 when your parents do it, and you can continue doing it from when you're earning.
Hmm.
I may be wrong, but 99% I'm sure you can start it as soon as you're born through your parents.
I understand. Wow. Well, that's nice. If we have such secure options available, then we should definitely make use of them, right?
I mean, PPF is actually the most underrated debt instrument to save, with the guarantee of government safety in every sense.
All right. Thank you, Govind. It was a pleasure having you as always. And viewers and listeners, as you heard Govind saying, that debt is a great way of securing your capital while also earning stable returns and balancing your own portfolio. So in the next episode, we'll be doing some other deep dives on different financial instruments, and we'll be continuing to do so that you can get the best financial literacy possible on our podcast. Thank you so much for having us,
Thanks, Kairav.
and we'll take your leave. Thank you, Govind.